What if I told you that some countries work hard, export valuable resources, and still remain poor for decades? What if the reason isn't what most people think? Today, we are diving into a question that challenges everything you've heard about global poverty. Is it bad leadership, bad luck, or something much bigger? Stay with me until the end. The answer might surprise you. And if you enjoyed deep, simple explanations of complex global topics, make sure to like this video and subscribe so you don't miss what's coming next. What if I told you that some countries work just as hard as the United States, produce valuable resources, and participate fully in global trade, yet remain poor decade after decade? Not because their people are lazy, not because they lack effort, but because the rules of the game may not be in their favor. Most of us grow up hearing a simple explanation. Poor countries are poor because of bad leadership, corruption, or lack of innovation. And while those factors can matter, they don't tell the whole story. If poverty were only about laziness, how do we explain countries where people work longer hours for a fraction of American wages? If it were only about intelligence, how do we explain nations filled with engineers, doctors, and entrepreneurs who still struggle under weak economic systems? Here's the uncomfortable question. What if poverty is not just a failure, but a position within a global structure? Think about this. Many developing countries export oil, minerals, coffee, cocoa, cotton, and rare earth metals. These are real resources, real value. The global economy depends on them. Yet the nations that supply these raw materials often remain at the bottom of the wealth ladder. Meanwhile, countries that manufacture advanced technology, control financial systems, and own multinational corporations accumulate far more wealth. So what's happening? Is it simply bad decisions? Is it corruption? Or is there a deeper economic mechanism that keeps certain countries dependent, indebted, and structurally disadvantaged? Before we jump to conclusions, we need to separate emotion from analysis. Poverty is rarely caused by one single factor. It's usually a combination of internal challenges and external pressures. Governance matters. Institutions matter. But global finance, trade systems, and capital flows also matter, often more than we realize. This chapter isn't about blaming anyone. It's about understanding the bigger picture. Because once we understand how the system works, we can begin to see why some countries struggle to move up, even when they try. So the real question we are asking in this video is simple. Is poverty a local failure, or is it partially built into the structure of the global economy? In the next chapter, we'll examine one of the most powerful forces that shapes this system, debt. To understand why many poor countries remain stuck, we need to talk about debt. Not personal credit card debt, but national debt. And the easiest way to understand it is through a simple example. Imagine you borrow $1,000. You agree to pay back $1,200 next year. But by the end of the year, you've only earned $900. You don't have enough to repay the loan. So what do? You borrow again. Maybe another $500 just to cover the difference. Now your total debt is even bigger. Next year, you owe even more interest. And the cycle continues. This is very similar to what happens in many developing countries. When economies face crises, falling exports, currency collapse, war, natural disasters, or global recessions, governments borrow money from international institutions or foreign lenders. The money is meant to stabilize the economy, support the currency, or cover essential spending. In the short term, borrowing can prevent total collapse. But loans come with interest. And over time, interest becomes heavy. Here's where it gets difficult. Wealthier countries usually borrow at low interest rates because lenders see them as safe. Poorer countries are considered risky. That means they often pay much higher interest rates. The more unstable the country appears, the more expensive it becomes to borrow. So the countries that need affordable financing the most often pay the highest price for it. Now add currency risk. Many developing countries borrow in US dollars. If their local currency loses value, their debt becomes even more expensive overnight. Imagine earning in pesos, shillings, or rupees while your debt is priced in dollars. If your currency drops 20%, your debt effectively increases 20% too. Without borrowing more money, your burden grows automatically. Over time, governments begin spending large portions of their budgets just servicing debt. Not paying it off, just paying interest. That means less money for healthcare, infrastructure, education, and industrial development. Instead of building long-term growth, they are maintaining financial survival. This creates what economists call a structural trap. The country needs growth to escape debt, but the debt payments reduce its ability to invest in growth. So it borrows again to fill the gap. The more it borrows, the more interest it must pay. And the more it pays, the less room it has to develop. Debt itself is not evil. Many rich countries use debt strategically to grow. The difference is stability, interest rates, and economic power. When a strong economy borrows, it usually invests in productivity that generates future income. When a fragile economy borrows under pressure, much of the money goes towards stabilizing crises instead of creating new wealth. Over time, the system begins to look less like temporary support and more like a permanent cycle. Borrow to survive. Pay interest. Borrow again. And when a country spends more protecting its credit rating than investing in its people, development slows down. In the next chapter, we'll look at another structural issue that shapes global inequality, the way trade works between rich and poor nations. Now let's move to trade. On the surface, global trade sounds fair. Every country sells what it produces best and buys what it needs. That's the theory. But in reality, not all products create the same level of wealth. Many developing countries export raw materials: oil, copper, lithium, cocoa, coffee beans, cotton, timber. These are essential resources. The modern world depends on them. But raw materials usually have low and unstable prices. They are commodities. Their value is determined by global markets, and poor countries have little control over pricing. Now compare that to what wealthy nations export: advanced technology, pharmaceuticals, aircraft, software, financial services, branded consumer goods. These are finished products. They include research, patents, marketing, design, and intellectual property. And finished goods sell for much higher margins. Think about coffee. A developing country might export raw coffee beans for a few dollars per kilogram. But once those beans are roasted, branded, packaged, and sold in a coffee shop in New York or Los Angeles, the value multiplies many times over. The country that grew the coffee earns a small fraction of the final price. The country that controls branding and distribution earns the majority. The same pattern exists in oil and gasoline, lithium and electric vehicles, cocoa and chocolate, rare minerals and smartphones. The early stages of production happen in poorer countries. The high-value stages happen in richer ones. This creates what economists call a value chain imbalance. Poor countries are positioned at the bottom of the chain. They provide inputs. Rich countries sit at the top. They control technology, processing, design, and global marketing networks. There's another problem: price volatility. Commodity prices fluctuate heavily. When global demand drops, raw material prices crash. A country that depends on exporting oil or copper can see its national income fall dramatically in a single year. Meanwhile, technology and branded products often maintain more stable profit margins. This makes wealthy economies more resilient. Over time, this imbalance creates a structural trade gap. Poor countries export large volumes but earn relatively low value per unit. They import high-value goods at higher prices. Money flows outward to pay for machinery, electronics, medicine, vehicles, and industrial equipment. Even when trade volumes increase, the wealth gap may continue growing. Because the issue is not how much is traded, it's what is traded and where the highest value is captured. So the problem is not that poor countries don't participate in global trade. Many participate heavily. The problem is their position within the system. They sell what is cheapest and buy what is most expensive. In the next chapter, we'll examine another powerful force that shapes this imbalance: the way profits and capital flow out of developing economies. Foreign investment is often presented as a solution to poverty. And in many cases, it does bring benefits. When multinational companies enter developing countries, they create jobs, build factories, introduce new technologies, and stimulate economic activity. On the surface, this looks like progress. But to understand the full picture, we need to follow the money. When a foreign corporation operates in a developing country, it generates revenue there. It hires local workers and pays wages. It may even pay some taxes. However, after covering local expenses, the majority of profits are often transferred back to the company's headquarters in a wealthier country. This process is called profit repatriation. Imagine a company earns $1 billion in profit from mining, manufacturing, or telecommunications in a developing nation. The workers receive salaries. Some taxes are paid locally, but the remaining profits are sent back to shareholders abroad. The wealth created inside the country does not fully stay inside the country. Over time, this creates a pattern where capital flows outward faster than it accumulates domestically. There is also another layer to this system: tax optimization strategies. Large multinational corporations often use complex accounting structures to shift profits to low-tax jurisdictions. Through transfer pricing and internal transactions between subsidiaries, profits may be recorded in countries with minimal tax rates rather than where the economic activity actually occurred. As a result, the developing country collects less tax revenue than expected. This weakens public finances. Governments have fewer resources to invest in infrastructure, education, healthcare, and industrial development. Instead of building long-term national capacity, they remain dependent on external capital. Now combine this with debt payments and trade imbalances. Aid money may flow into a country. Foreign investment may enter. But at the same time, interest payments, corporate profits, and dividend transfers flow out. When economists calculate the net effect, many developing nations experience a negative capital balance. More money leaves than enters. This does not mean foreign investment is inherently harmful. In fact, many countries have successfully used foreign capital to accelerate development. The difference lies in regulation, negotiation power, and long-term strategy. Countries that manage to retain more value locally, by building domestic industries, enforcing fair taxation, and reinvesting profits, are better positioned to grow. But when foreign capital dominates key sectors without strong local institutions, economic control remains external. The country participates in the global economy, but it does not fully capture the wealth generated within its borders. The result is subtle but powerful. Jobs exist, production happens, exports rise, yet national wealth grows slowly. Capital continues circulating globally, but accumulation concentrates elsewhere. In the next chapter, we will explore whether this cycle can be broken and what separates countries that escape poverty from those that remain trapped within it. At this point, the picture may seem discouraging. Debt pressures governments. Trade structures favor higher value economies. Profits flow outward. Capital accumulates elsewhere. But here's the important truth. The cycle is not impossible to break. History shows that some countries have escaped poverty and dramatically transformed their economies within a generation. South Korea in the 1960s was poorer than many African nations at the time. Singapore had almost no natural resources. Ireland struggled for decades with low income and unemployment. Yet today, all three are considered high-income economies. What changed? First, they invested aggressively in education. Not just basic literacy, but technical skills, engineering, science, and industrial knowledge. They built a workforce capable of moving up the value chain instead of remaining stuck at the raw material stage. Second, they focused on industrial development. Instead of only exporting commodities, they built domestic manufacturing capacity. They produced finished goods, not just inputs. Over time, they developed their own brands, technologies, and global companies. Third, they strengthened institutions. Stable governance, predictable regulations, and long-term planning created confidence for both domestic and foreign investors. Corruption was reduced, contracts were enforced, and policy remained relatively consistent. Fourth, they strategically managed foreign capital. Rather than allowing unlimited profit extraction, they negotiated terms, required technology transfer, and reinvested gains locally. Foreign investment became a tool for national development, not a permanent dependency. This does not mean the global system is irrelevant. External pressures still matter. Dollar dominance, financial markets, global trade rules, and geopolitical power shape opportunities. But internal strategy determines how a country responds to those pressures. Breaking the cycle requires shifting from survival to strategy. Instead of borrowing simply to stabilize crises, countries must invest in productivity. Instead of exporting only raw materials, they must capture more value through processing and innovation. Instead of allowing unchecked capital outflows, they must strengthen tax systems and reinvest profits domestically. The key difference between countries that remain poor and those that rise is not luck. It is how effectively they build human capital, industrial capacity, and institutional strength while navigating global constraints. So we return to the central question: is poverty caused by internal failure or by global structure? The honest answer is that it is usually both. Weak institutions make countries vulnerable, but structural disadvantages make development harder. Understanding this balance is crucial, because once we recognize that poverty is shaped by systems as well as decisions, we can have a more serious conversation about reform, responsibility, and opportunity. The future of developing nations will not be determined by one single factor. It will depend on whether they can redesign their position in the global economy, from raw supplier to value creator, from debtor to investor, from dependent to competitive. And that transformation, while difficult, is not impossible. Now the real question is this: is poverty a failure of leadership, or a flaw in the global system? I want to hear your opinion. Drop your thoughts in the comments below. If this video made you think differently, hit the like button and subscribe for more deep dives into how the world really works. See you in the next one.